Hey everyone, welcome back to Corporate Decoder, the place where we decode the fascinating and sometimes baffling world of corporate finance. Today, we are diving deep into a report that smells like a fresh funding round and at the market offering and the end of an old one. It seems iBio Inc. is getting ready to sell some more stock, but they're also wrapping up an older deal. Let's see what this all means for the company and its investors. Before we get into the nitty gritty, if you enjoy these clear, no fluff breakdowns of financial reports, hit that subscribe button. And for a deeper chat with fellow finance enthusiasts, join our Discord community linked in the description below. Alright, so the big news here revolves around iBio Inc., a company that has been in the biotech space. This report is being filed on the 27th of February 2026, but the earliest event reported is actually the 23rd of February 2026. And that is a pretty significant date because it marks the termination of a past agreement. This old agreement, called the At-Market Issuance Sales Agreement, was with Chardon Capital Markets LLC and Craig, Hallam Capital Group LLC. Think of it as a deal where iBio allowed these firms to sell their shares on the stock market, essentially to raise money. They had a plan to raise up to about $7.35 million through this, but now that chapter is closed. The company sent out a notice to end this arrangement, meaning no more shares will be sold under that specific deal, and importantly, no more money will be raised through that old prospectus. But don't get too worried about them running out of ways to raise cash. Just 4 days later, on the 27th of February 2026, iBio inked a brand new deal. This one is called an Open Market Sale Agreement, and it is with Jefferies LLC. This is essentially another at-the-market offering, or ATM as it is commonly known. It's a flexible way for companies to sell shares directly into the stock market whenever they see fit, up to a certain amount. This new ATM agreement allows iBio to sell its common stock, which is the basic ownership kind you see traded every day, through Jefferies. The company gets to set the rules for these sales, like how many shares they want to sell, when, and at what price. Jefferies, on the other hand, will do its best to sell these shares either on the Nasdaq stock market or other trading venues. This is a standard way for companies to get extra funding without a big, disruptive announcement. Now, for any of these sales to happen, iBio needed a registration statement. Think of this as a formal declaration to regulators like the Securities and Exchange Commission or the CSE that they are allowed to sell more stock. They filed this on Form S-3, and it allows them to potentially sell up to $100 million worth of their common stock. Keep in mind, they are saying there is no guarantee this registration statement will actually become effective or stay effective. So, while the agreement is in place, the actual selling of shares still hinges on approval from the SEC. It's crucial to understand that iBio is not forced to sell any shares here. They can decide to stop these sales at any time, and Jefferies is not obligated to buy any of the shares on a principal basis. They are essentially acting as an agent trying to find buyers when iBio gives the green light. Now, about the costs, iBio will be paying Jefferies a commission for their work, and this commission can be up to 3% of whatever money they raise from selling these shares. On top of that, iBio will be covering Jefferies' legal fees up to a hefty $100,000 just to get this agreement set up. They'll also pay additional amounts for filings with the SEC, like annual reports and quarterly updates. This shows that while ATM offerings are flexible, they certainly come with their own set of costs. iBio's common stock, which has a very small par value of $0.001 per S-share, is traded on the Nasdaq Capital Market under the ticker symbol iBio. This is the stock that will be available for sale under this new ATM agreement. So what does all this tell us? iBio is actively managing its capital structure. They're closing out an older, smaller fundraising effort and immediately pivoting to a much larger potential fundraising opportunity with Jefferies. This suggests they might have plans that require significant capital, or they are simply ensuring they have a robust cash runway. The fact that they are terminating one agreement and immediately entering into another points to a proactive approach to financing their operations, which is common for companies in the biotech sector where research and development can be very capital intensive. Looking at the broader picture, iBio has a registration statement filed that could allow them to raise up to $100 million. This is a substantial amount, and it signals a belief from the company's management that they can indeed move shares in the market. However, the disclaimer that the registration statement might not become effective is a standard, but important, piece of legal language. It means all these plans are contingent on regulatory approval. The strategy of using at-there market offerings is generally seen as a way to raise funds opportunistically. Companies can tap into the market when stock prices are favorable or when they need to cover immediate operational needs without the extensive process of a traditional stock offering. For investors, This means there is a potential for dilution if iBio decides to sell a significant number of shares. Dilution happens when the total number of shares increases, which can reduce the ownership percentage of existing shareholders and potentially their earnings per share. The shift from one ATM provider to another, like moving from Chardon Capital Markets and Craig Hallam Capital Group to Jefferies, might indicate a few things. It could be that the previous agreement was reaching its end or had limitations they wanted to overcome. Or it could simply be a strategic decision to work with a new partner who might offer different capabilities or a better execution strategy. The fact that they are paying Jefferies up to 3% commission and significant legal fees highlights the cost of this flexibility. In conclusion, iBio is making moves to secure funding through an at-the-market offering. They've ended an old chapter and opened a new one with Jefferies, aiming for a much larger potential capital infusion. Investors should keep a close eye on the effectiveness of their SEC registration and any actual share sales that occur. The company's direction appears to be focused on growth and development, which often necessitates significant capital. The risks here are largely around execution and market conditions. Will iBio successfully raise the desired capital? And how will that capital be deployed to drive value? That is the $100 million question. Alright, that is our breakdown of iBio Inc. Slate is filing. What is your take on these funding strategies and what they signal for iBio's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.